Hi there, Mark S. Brantley, your host of Boardroom Minutes. First, I would like to welcome you back to another episode of Boardroom Minutes, which is your premier channel for clear, concise insights into the issues that shape today's boardrooms. And that's at for profit corporations, nonprofit organizations, and religious institutions like churches. Our topic on today is fiduciary duty, to whom it is owed. Again, welcome back to Boardroom Minutes. And if you have not yet subscribed to this channel, why don't you do so at this time? And then also you can hit the like button. Or if you decide to wait until after you view this episode, and if it's beneficial, you can like it at this time. Also, feel free to share it so that others can be informed about issues concerning the boardroom. All right, let's go into our topic, which is fiduciary duty. To whom is it owed? Now, on previous occasions, we've talked about fiduciary duty from time to time because, as a director or a trustee, regardless of the organization or the institution, there is fiduciary duty that is owed. And we define fiduciary duty as a legal obligation of a person who is entrusted to act in the best interests of another party. And it typically includes the duty of care, the duty of loyalty, the duty of obedience, the duty of transparency, and the duty of confidentiality. And all those duties are wrapped up into the general term, which is fiduciary duty. Now, we've again talked about it, we've defined it in times past, but we really never touched on the question of to whom is it owed? To whom is fiduciary duty owed? And that typically plays out when it comes to if it's a for-profit corporation, is the duty owed to the shareholders or is the duty owed to the corporation or the corpus? If it's a nonprofit organization like a church, is the duty owed to the members or the duty owed to the church or the institution itself? And the same for credit unions, which is a member owned cooperative. To whom is the duty owed? Is it owed to the membership or is it owed to the corporation itself? And really, in a nutshell, to answer that question, it is owed to both. You have to balance it and make decisions based on the duty being owed to both. And typically that balance is struck when you think of it in a way that you owe the fiduciary duty to the corporation in the best interests of shareholders, or for nonprofits, in the best interests of the members. Why? Because if the institution or the organization doesn't exist, then it can't benefit the members. But you also want to keep in mind that you represent your members. Typically, your members are who vote for you or elect you to your position. And then also for shareholders, they as well elect the directors to sit on the board of corporations. So it's sort of a duality where you owe an interest to the corpus, but to the benefit of either the shareholders or to the members. Now, in a real world example, let's look at a recent policy that has come down from Washington, D.C., and that is the proposed cap on interest rates for credit cards. There is a pending proposal to only allow interest at a 10% APR to be charged to customers of banks or members of credit unions. You see, credit unions are not-for-profit financial institutions, and they have member owners. The credit unions are cooperatives, as opposed to banks who have customers. They have shareholders too, but when we speak of those that transact business, they are customers. And the 10% cap would be for the customers of banks, but for the members of credit unions. So, on its face, a 10% APR cap on credit cards sounds like a great policy. And for customers of banks and for the members of credit unions, that's a win-win scenario. Who would not like to have a 10% cap where for a year the institution cannot charge you above 10%? So for the members or for the customers, that's a great policy. It allows you to save. The costs with regard to the interest rates are down, and you have more disposable income to utilize for other alternative means. However, although it's good for the customer and although it's good for the member, it may not be good for the financial institution, namely the bank or the credit union. And the reason why is that even though financial institutions, they earn profit from credit cards, and it's part of their balance sheet in terms, and also their profit and loss statement. That is not the sole reason why interest is charged at different rates. Let me give you an example. Typically, interest rates are priced because the financial institution has to balance access to credit with also risk. In a more real world sense, let's take two customers of banks or two credit union members. And you may have a credit union member or customer of a bank whose credit is stellar, and versus the credit union member or customer whose credit is not so stellar. So for the stellar credit customer, the risk is less of default than it is for the one whose credit is not so great. So as such, the risk has to be offset because there's a greater likelihood of the person with not so stellar credit to default on their payments on the credit cards versus the member or customer who has great credit. You know the FICO scores. You have a paper, which is like 700 to 800 in terms of the FICO score. And then you have not so great credit or average credit, which is around 500 to 600 or so. And then even less stellar credit, which is below 500. So as you get a credit score which is lower in number, the higher the interest rate on the credit card that is offered to the member or to the customer, because you want to offset the risk. And as such, you are making decisions and looking at fiduciary duty through the lens of the corporation. Because if you have your loan portfolio that includes credit cards with high delinquency, then that is bad for the institution. So as directors and trustees, sometimes you may need to implement policies or view policies through the lens of how does it impact the institution. And in that instance, the fiduciary duty is owed to the corporation. Because if you have only 10% cap and you, as I mentioned, on its face, it's great for the customer or the member, that may cause you to decide to lower access to credit to those members who are at greater risk of default, meaning those that have lower FICO scores. And credit unions always believe in the philosophy of people helping people. And as such, you want to give as much access to credit as you can. But if you have a policy that ties your hands, that policy, although may be good for lowering costs for members or customers, it will then stymie the institution's ability to offer credit to those that may not have such a high FICO score. So, in that instance, you have to make decisions. Should I do so on behalf of members and customers, even though it may be favorable toward them? But in the long run, when you look at it for the benefit of the corporation, now through that 10% cap, I'm not able to give credit to those who have lower FICO scores because I'm not able to offset the risk in terms of the interest rate. So rather than now charging 15%, I no longer can offer that. So therefore, rather than risk at 10%, I'm not going to offer the member any credit. And that is the downside of such a policy. So, to whom is fiduciary duty owed? It's owed to the corpus, to the corporation, but to the benefit or for the benefit of the customer, if it's a financial institution like a bank, or to the member, if it's a not for profit financial institution like a credit union, or a member who is part of the membership for a nonprofit organization. So I hope that sort of gives you an understanding about fiduciary duty and to whom it's owed. And let me also say that when decisions are made, because we talked about the duty of care, you have to make sure as a director or a trustee that you are deciding or making a decision using what a reasonable, prudent person would do in that circumstance. So, in other words, as a director or trustee, you have to do your due diligence. That is making sure you dot your I's and you cross your T's, because in the final analysis, the buck stops with the director. It stops with the trustee. So, although you are in favor of lowering costs for the customer or the member, depending on the financial institution, you still need to look out and make decisions for the well-being of the corporation. Because if the corporation fails and ceases to exist, then what is the benefit that is being given to the members who you represent and who elect you to your seat? So I hope that gives you somewhat of an understanding, some of the tension that is involved in being a director, being a trustee on a board, and the thought process that goes into making the right decisions. All right. I think we're going to end it right there. Again, this is Mark S. Brantley, your host of Boardroom Minutes. Hope you enjoyed it. Again, if you haven't liked this episode as of yet, why don't you hit that like button? And if you haven't subscribed, why don't you do so as well? Mark S. Brantley signing off for another episode of Boardroom Minutes. Take care.